Let me tell you something most people never grasp until it's far too late. You don't need 100 tricks to get rich, you just need a few good habits and the discipline to stick to them for 50 years. Everyone's chasing the next hot stock, the next crypto coin, the next miracle strategy. Meanwhile, the real wealth builders are quietly doing the same 5 boring things over and over again until the world calls them genius. So let's talk about those 5 brutally simple investing rules, the kind that actually work. The first rule of making money is brutally simple: don't lose it. People laugh when they hear that. They think it's too obvious to matter. But that's exactly why most of them stay broke. The world is full of smart people who underestimate how devastating losses are to compounding. Lose 50%, and you need a 100% gain just to get even. That's not arithmetic, that's the road to despair. The math of recovery is far uglier than the math of return. Every great investor learns this lesson, usually the hard way. They don't win by picking more winners than losers. They win by avoiding the disasters that wipe out years of progress. One catastrophic mistake can undo a decade of good decisions. So the truly wise investor doesn't wake up asking, how much can I make? But rather, how much could I lose if I'm wrong? Avoiding losses isn't about being timid. It's about respecting probability. The markets don't reward boldness, they reward survival. If you can stay in the game long enough, compounding will do the heavy lifting for you. But if you blow up early, if you bet too big, borrow too much, or trust the wrong people, the game ends permanently. That's why the best investors are obsessively focused on downside protection. They think in terms of risk per unit of return, not just the return itself. They never let enthusiasm override mathematics. They understand that a consistent 10% return compounded safely for decades beats a wild 50% one year and a 50% loss the next. The amateurs chase fireworks. The professionals guard compounding. You protect yourself in 3 ways: margin of safety, discipline, and humility. A margin of safety means never paying a foolish price for even a great business. No matter how wonderful a company looks, it's not wonderful at the wrong price. Overpay, and even perfection won't save you. The discipline is refusing to compromise that rule, even when everyone around you is losing their minds. Markets tempt you to abandon reason, they seduce you with greed and fear. Discipline means saying no more than yes. And humility, that's the rarest form of intelligence in investing. It's accepting that you will be wrong, often and expensively, if you let ego drive decisions. The humble investor designs a system that assumes mistakes will happen and makes sure none of them can kill him. The arrogant investor bets as if the future owes him clarity, and the market always collects its revenge. Never losing money also means avoiding the environments that breed stupidity. You don't need to play in every casino the market builds. Complexity, leverage, and hype are the fastest routes to ruin. The world will always offer you a chance to get rich quick. It never offers you a second chance after you blow up. If something looks too good to be true, it usually already belongs to someone else, the one selling it to you. Preservation of capital is not a strategy, it's a mindset. It's the foundation of every real fortune. Think of money like oxygen. You don't notice it when you have enough, but the moment you lose it, nothing else matters. Your first duty is to stay alive financially. Only then can you think about getting rich. This is why the greatest investors treat every decision with paranoia. They're not pessimists, they're survivors. They know that compounding is a fragile miracle, easily broken by one reckless move. Protect it fiercely, defend it daily, and never forget, getting ahead is optional. Staying ahead is mandatory. If you don't understand it, don't touch it. That single rule would save investors billions every year. Most people lose money not because they're stupid, but because they refuse to admit what they don't know. The desire to look smart often costs more than ignorance itself. In investing, humility isn't optional, it's survival. Understanding a business means knowing how it actually makes money, how it can lose money, and what its future economics realistically look like. It means reading the financial statements, studying the competition, and testing whether the business model would still make sense if you stripped away the buzzwords. If you can't explain how a company earns profits in one or two clear sentences, you don't understand it well enough to risk your capital. The world constantly tempts you to step outside your circle of competence. There's always a new thing, new technology, new market, new miracle stock. The crowd rushes in, seduced by stories they barely grasp. They don't analyze, they fantasize. They buy narratives instead of numbers. And when the story changes, they discover they never owned a business, they owned a dream. Every investor has a limited circle of competence. The trick is not to enlarge it recklessly, but to know precisely where its borders lie. Staying within that circle doesn't limit your opportunity, it protects your judgment. The person who sticks to what they deeply understand will outperform the genius who jumps into everything. Expertise compounds. Confusion destroys. When you know a business deeply, you see reality instead of illusion. You recognize whether growth is genuine or borrowed. You can smell when management is selling hope instead of performance. You can tell the difference between a temporary dip and a permanent decline. That clarity lets you act rationally when others panic. Understanding isn't about knowing everything, it's about knowing enough to stay calm when the market loses its mind. There's a reason professional investors spend most of their time saying no. They reject 99% of opportunities, not because they dislike money, but because they understand risk. Every new investment carries the possibility of hidden ignorance, an unseen variable that can ruin everything. The less you understand, the more that variable grows. The best way to manage risk is to avoid it in the first place. Complexity is a trap. The more complicated a business sounds, the more fragile it usually is. Simplicity is the friend of reliability. A great investment should make sense even if you explained it to a child. We buy this product at this price and sell it at that price. The customers keep coming back. Costs stay low, profits grow. If it takes 10 slides and a PhD to explain how money is made, walk away. Complexity hides danger, and danger hides loss. When you invest in what you understand, you can make independent decisions. You aren't relying on analysts, influencers, or market rumors. You're standing on your own reasoning. That independence is your greatest advantage. The moment you need someone else to tell you what you own or why you own it, you've already lost control. Ignorance isn't shameful, pretending you don't have it is. The most successful investors aren't the ones who know the most, they're the ones who are most honest about what they don't know. They make money by staying within their boundaries, letting others fight over what they can't predict. Knowing where you're dumb is more valuable than pretending to be clever everywhere. The market punishes arrogance. Every bubble is built on people buying things they don't understand, convinced that someone smarter will take it off their hands later. That's not investing, that's speculation dressed up as confidence. When the music stops, understanding is the only chair left to sit on. So stay within your circle, study deeply, wait patiently. When you understand something well enough to trust your analysis, through panic and euphoria alike, that's when you invest, not before. The secret of wealth isn't brilliance, it's duration. Compounding is the eighth wonder of the world, but it only works for the patient. Time is the multiplier that turns ordinary returns into extraordinary fortunes. Yet most investors treat time like an inconvenience instead of an ally. They chase fast results, jump between ideas, and wonder why they never build lasting wealth. Compounding works because it turns discipline into geometry. A dollar earning 10% grows slowly at first, then violently later. But the curve only bends upward if you leave it alone. Interrupt compounding, and you kill the magic. The biggest returns always come at the end, not the beginning. Most people never reach that stage because they can't resist tinkering, trading, or reacting to noise. The market rewards endurance, not activity. A long-term investor makes money while everyone else is busy being clever. The constant buying and selling that looks like sophistication is usually disguised impatience. Time favors those who sit still with good assets and strong convictions. The longer your holding period, the fewer decisions you must make and the fewer chances you have to make big mistakes. Thinking long-term means focusing on business quality, not market drama. A great business compounds internally whether the market cheers or boos. The short-term investor obsesses over price. The long-term investor studies value. One watches the scoreboard, the other studies the game. Over time, price catches up to value, but only for those willing to wait. Patience is not passive, it's concentrated strength. To hold an investment through cycles of greed and fear requires emotional stamina and a rational framework. When prices drop, the impatient call it failure. The long-term investor calls it opportunity. Time converts volatility into profit for those who can control their temperament. Short-term thinking is expensive. It triggers taxes, fees, and constant stress. Every decision has friction, and friction compounds in reverse. The investor who trades endlessly feeds the brokers and starves himself. Meanwhile, the quiet investor, content to sit on quality, lets compounding quietly work. Boredom is often the best strategy in finance. A long-term mindset demands faith in arithmetic, not luck. If you buy productive assets, businesses that grow earnings year after year and hold them through storms, mathematics does the rest. Small, consistent gains become monumental when given decades. But if you keep resetting the clock, you never reach the exponential phase. Starting over repeatedly is financial self-sabotage. The hardest part of thinking long-term is enduring short-term nonsense. Markets will test your conviction. Prices will fall for no reason. News headlines will scream apocalypse. That's when your philosophy either holds or breaks. The long-term investor understands that volatility isn't risk, it's the cost of admission for higher returns. If you can't handle seeing temporary losses, you don't deserve permanent gains. Compounding also applies to knowledge. The longer you study, the sharper your judgment becomes. The investor who keeps learning compounds insight the same way capital compounds interest. Over decades, small improvements in reasoning produce enormous advantages. A long-term mindset turns both money and wisdom into exponential assets. Time is the ultimate judge of strategy. You can't fake long-term results. Eventually, only reality compounds. The market forgets speculation but remembers consistency. The investor who treats time with respect ends up owning the assets everyone else traded away in a panic. Thinking long-term isn't about predicting the future, it's about preparing for it. You build positions that can survive recessions, inflation, and fashion. You ignore noise, trust compounding, and focus on staying solvent. That's not exciting, but it's effective. Patience, discipline, and rationality, those are the real engines of compounding. Anyone can make money for a year. Very few can build wealth for a lifetime. The difference is time. Let it work, and it will do what intelligence alone never can. You can't do a good deal with a bad person. That single sentence has saved more fortunes than any spreadsheet ever built. Character is the first filter in business and the last line of defense when everything else fails. You can survive bad luck, but you can't survive bad partners. Integrity is not a decoration. It's a foundation. Without it, every agreement is temporary, every success unstable. The wrong partner will turn profit into poison. They'll exploit your trust, twist your words, and leave you explaining what went wrong long after they've walked away richer. That's why the smartest investors spend more time judging character than analyzing numbers. Numbers change, human nature doesn't. Intelligence is useful. Integrity is non-negotiable. A brilliant crook will always find a way to hurt you. The best outcome you can expect from a dishonest person is disappointment. The worst is ruin. The cost of aligning with the wrong character is infinite, because deceit compounds faster than capital ever could. Choosing the right people is a form of risk management. In investing, you can't control markets, but you can control associations. Surround yourself with rational, honest, competent people who tell the truth even when it costs them. A good partner won't just share profits, they'll share discipline. They'll call you out when your thinking drifts, and they'll expect you to do the same for them. Mutual accountability is the invisible asset behind every lasting partnership. The best alliances are built on trust so strong it makes contracts almost unnecessary. But the existence of that trust requires years of consistent behavior. You don't discover integrity in conversation, you observe it in crisis. Watch how people behave when money is on the line or when no one is watching. That's the real audit. Avoid those who treat ethics as strategy. The moment someone views honesty as a tactic, they've already compromised. Character isn't situational, it's structural. It's the framework that keeps judgment stable when greed, pressure, and temptation rise. You want partners whose instincts lean toward fairness, even when it's inconvenient. Intelligence matters because good intentions can't fix stupidity. The world is full of honest incompetence, people who mean well but can't think straight. Partnering with them leads to slow losses instead of fast ones. You need people who combine intellect with principle, the ability to reason clearly and the will to act honorably. One without the other is incomplete. A person's temperament is just as critical as their skill. An unstable partner will drag you into chaos. Emotional volatility infects decision-making. Choose people who stay calm under pressure, who think in probabilities, not emotions. Rationality and composure are rare. When you find them paired with integrity, hold on. Partnerships amplify everything. The right one multiplies your effectiveness. The wrong one multiplies your problems. A dishonest partner doesn't just steal money, they steal time, focus, and reputation. Recovering from that damage can take years. That's why due diligence on people is more valuable than due diligence on projects. You don't need many allies. You need the right ones. A small circle of competent, ethical people beats a large network of opportunists. Trust scales better than deceit. When everyone in a group shares integrity as a baseline, communication speeds up and friction disappears. Energy that would be wasted on suspicion is redirected toward productivity. Good partners don't flatter you. They challenge you. They argue logically, admit when they're wrong, and expect the same honesty from you. They understand that truth builds wealth faster than harmony built on lies. The most profitable relationships are not the easiest. They're the most transparent. In the end, association is destiny. You will drift toward the behavior of the people you spend time with. Work with the wise, and you'll grow wiser. Work with the dishonest, and you'll learn their tricks right before you become their victim. Choose partners whose integrity you'd bet your future on, because in practice, that's exactly what you're doing. The market is a machine powered by human emotion, greed, and fear, turning the gears in opposite directions. Most investors don't lose because of bad information. They lose because they can't control themselves. When prices rise, greed whispers that the party will never end. When prices fall, fear convinces them the world is ending. The rational investor stays silent in both moments and thinks. Rationality is the rarest asset in markets. It's not intelligence or education. It's emotional discipline. The ability to detach from the hysteria around you is worth more than any forecast or insider tip. Markets test your temperament far more than your intellect. Everyone sounds rational in calm weather. True composure appears only in storms. The first step toward rationality is accepting that emotions are constant companions. You can't eliminate them, but you can prevent them from steering. Greed makes you overestimate opportunity. Fear makes you underestimate endurance. Both distort judgment. The disciplined investor builds guardrails, rules, and principles that override emotion before emotion overrides them. Panic is contagious. So is euphoria. That's why markets move in herds. The rational investor recognizes crowd behavior and steps aside instead of joining it. When everyone agrees, prices already reflect that agreement. The moment of consensus is the moment of maximum danger. Thinking independently is uncomfortable, but comfort is a terrible predictor of profit. Being rational doesn't mean being cold or contrarian for its own sake. It means aligning with reality, not emotion. When prices drop, rationality asks, has intrinsic value changed? If not, lower prices are opportunity, not tragedy. When prices surge, rationality asks, has value caught up? If not, it's time to hold back, not join the parade. The crowd feels, the rational mind measures. The market preys on impatience. It sells drama to those who crave action. Every headline screams urgency because urgency triggers reaction, and reaction feeds volatility. The rational investor ignores noise and focuses on process. They read data, not predictions. They measure probabilities, not popularity. By refusing to dance to the market's rhythm, they conserve the most precious investing resource, composure. Discipline in emotion is discipline in capital. Fearful investors sell at the bottom, greedy investors buy at the top. Both lose to the calm investor who waits. The ability to sit quietly while others scream is not arrogance, it's strength. Emotional control lets compounding continue when chaos tempts interruption. Rationality also means intellectual honesty. You question your own conclusions. You seek disconfirming evidence instead of flattering data. The emotional investor searches for validation. The rational one searches for truth. Admitting ignorance is part of reason. Pretending certainty is the language of panic. The calm investor says, I don't know, more often than the reckless one says, I'm sure. History rewards rationality. Every crash, bubble, and mania repeats the same human pattern, excess followed by regret. The rational investor doesn't predict when it ends. They simply avoid being caught in it. They let others celebrate unsustainable profits while they quietly prepare for the reversion that always follows. Rationality is not about timing the market, it's about not being destroyed by it. Temperament is your true competitive edge. You can't control prices, rates, or headlines, but you can control reaction. That's what separates survivors from casualties. The market punishes the impulsive and rewards the consistent. Emotional investors play short games. Rational investors play infinite ones. Patience looks foolish when greed dominates and heroic when fear takes over. The rational investor endures both seasons with the same face. They act on logic, not mood. When others lose their heads, they keep theirs, not because they feel nothing, but because they've trained themselves to think despite feeling everything. Being rational when others are emotional is not natural. It's practiced. It's a daily discipline of thinking clearly, doubting noise, and trusting process. In the long run, markets transfer wealth from the emotional to the rational, from the impulsive to the patient, from the reactive to the deliberate. Staying sane when the world goes mad is not easy, it's profitable. Now listen carefully, these rules are not exciting. They don't make headlines. They make fortunes. If you live below your means, stay patient, avoid stupidity, and let time do the heavy lifting, you'll look like a genius someday. But remember, the secret isn't IQ, it's character. Anyone can get rich once. Staying rich, that takes discipline. So stop chasing shortcuts. Study, think, act slowly, and stay calm. In a world obsessed with noise, be the person who compounds quietly. That's how wealth and wisdom are really built.